Jim, I want to just start with earnings season. We're all trying to figure it out because we're getting some pretty good beats over what the expectations were, but the guidance and the look forward is just full of uncertainty. Do you think that we are fairly valued where we are right now for the expectations on this economy and these companies?
Well, I'd say collectively, in the aggregate, I think we're seeing reasonable valuations, and I wouldn't be upset. I wouldn't be surprised to see us somewhere around the 3,500 level at year end. There is some maybe internal dynamics that changes that a little bit. For example, telecom, high quality growth has certainly had a strong wind to its back. I think there's still opportunity there, but on a relative basis, we might see some underperformance. And I think there's an opportunity for us to see maybe a little bit of resurgence in some of the more beaten up names as we really start getting a clearer picture of when or if some sense of normalcy starts coming back.
So are you looking at value here, overgrowth, or are you in that camp?
No, I mean, I don't think we really shift gears and start thinking about value given the dynamic that we're seeing in the market today. I think growth is still the primary driver, but we do need to be thinking forward for maybe when that dynamic changes. And I do think that's going to be very back to normal, very vaccine oriented when we get there. But obviously, there's been a huge disparity in growth versus value. A lot of pundits would say we're due for a reversion to the norm. I wouldn't disagree with them, but I'd be looking at value in other non-cyclical sectors before I was looking at some of the true value names, especially given the headwinds that, say, financials and energy are likely to face in the current quarter and even into next year.
So if you are looking for yield right now, but you are also a little bit apprehensive given the election coming up, where do you think is the best bet?
Well, certainly we're in an environment where with quantitative easing and with modern monetary policy, we're likely to see low rates for a very long time, even in the face of an uptick in inflation. And with that in mind, fixed income is not the animal it ever was, or it certainly hasn't been that animal since my dad's day doing this. So I'd say a bias towards dividend-paying stocks, especially high quality stocks, say in the telecom sector, utilities, certainly an opportunity there. Again, sticking with the higher quality side, looking at dividends in the value side, or looking at the beaten up names or names that haven't really turned the corner with regard to the economic standpoint, or in essence chasing yield. I think that gets a little bit scary. But sticking with the high quality names and maybe having a bias for dividends in the portfolio, I think makes sense right now.
Well, looking at utilities, XLU tipping up right now, real estate as well, a little bit choppy sector-wise and on the overall market here. Jim Bruderman, 1879 Advisors Vice Chairman, really great to get a chance to talk with you. Thanks so much.
Thank you. Pleasure.